So in the next few minutes, I'm gonna give you a complete crash course on how futures actually works and how you can get into it. So first things first, futures is not like anything else that you can trade on the markets. You have options, you also have stocks, you have bonds, commodities, but futures takes a different path. The main difference is that with futures, instead of holding a stock from Apple or Microsoft, you actually buy a full contract, which allows you to be able to add leverage onto that position. So instead of that one-to-one leverage that you get with a stock as it moves up $1 or minus $1, with futures you actually get leverage. So as the commodities begin to move, let's take gold for example. If gold shoots up 50 points and you're in a leverage position, you might be able to make $2,000, $3,000 instead of just that $50 amount. The main reason people like this is because you can actually leverage contracts, saying that you're going to buy 100 ounces of possibly gold or oil in the future, and you can sell that for a higher price within the given time. The main thing that people do is they're going to buy and sell the contract values just like options, and they're going to be able to make money based off of the price movement of the actual commodity. So between me and you, basically day trading on a leveraged account. So the one thing that I like to call the big three of margins is assets, volatility, and time. I would say these are the big three because this is what really controls the margin amount that you're able to purchase one contract with. So let's say an example, you have about $10,000 in the account. You would take about $500 as a margin for one contract of NASDAQ, and then you'd be able to trade one mini on NASDAQ and be able to make as much as you possibly could depending on the NASDAQ movement. Which is going to take us to MNQ, which you call the micro NASDAQ contract. Basically with these, it's about 1/10 of the size of a regular mini contract, thus they call it micros. And with that, you'll be able to more easily exit and close some positions once you're trying to either get in with half size or possibly get out with any amount size you want. Basically, it's just giving you a way to be able to make money but also manage your position the right way. See, what this allows is that you can actually start with a small amount, possibly not with that full $500 size, but you're also able to put down margin to be able to trade these smaller contracts to make money in the meantime. Sometimes trading those big minis can definitely take a blow on your account if you have the wrong position, right? So if you're trying to really dial in your risk management, you have to use the micro contracts to be able to enter and exit positions as smooth as possible. So every single futures contract is actually based off of a tick price. So this will move about 4 ticks per dollar amount. So if you see the price going up and you see it shooting up all of a sudden, it goes up $4. It's really moving just about 16 ticks in that $4 price spread. Now, if you look at the point value versus the tick value of things like oil is about $10 per tick. You have the micro contract being about 1/10 of that at $1. Same goes for gold, and for ES, the S&P 500, it's about $12.5, and then also 1.25 per micro. So futures are extremely powerful and easy to be able to leverage big positions to be able to make as much as possible whilst minimizing your risk. Using the micro contracts is going to be your best bang for your buck, and if you really dial in your risk management and have a trading plan that you follow every day consistently, you'll be able to take off. Let's go. Make 2026 your and keep turning up with the trading. Let's go, y'all. Dial in for the new year. Turn up. On to the next.
Execute your futures trades on. You can check